All right, stocks finished really strong coming off a better than expected jobs report. So we had a good little near-term bounce heading into the end of the week. We've been talking about some expectations for that. But then the expectation was that we're not going to go any further. So we're going to take a look at the technicals to see if that's still the case or not. Break down what we expect to see going forward, what's driving this action for what asset, how the asset rotation and sector rotation is going on. I'm going to describe all that, and then look for a bullish trade opportunity. Now that the posture's turned bullish, you'll see we look for a trade, but we have to be really picky with what we find. So I'm going to show you how to do that. Let's go ahead and get started. My name is David Settle, and this is my market outlook for today, Friday, December the 8th, 2017. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Keep coming back for more. Subscribe to my YouTube channel by clicking that red subscribe button that's right down there below the video. Also, hit that thumbs up that's right next to it to let me know that you liked the video today. You got something out of it. It's one click, easy way to give me some feedback. Scroll down and comment on anything that stood out to you from today's video. And of course, in the description of this video, there's a bunch of links there. Subscribe to my daily email newsletter for this video, for the Market Outlook, by clicking on that link. Follow me on Twitter for more content in addition to these videos. You'll see my handle up there. I believe it's this direction, at DavidSettle42. And of course, join the Market Outlook community on Facebook. You'll see that address up there as well. You'll also see that a link that will get you straight there in the description down below. All right, let's take a look at the market forecast for the S&P and look at that. So we bounced up again today, continuing this near-term bounce on the S&P 500 that we've been talking about, coming up off that support level there, 38% Fibonacci retracement. Excuse me, the near-term line coming up off of what can be considered a bullish near-term low point because it's between 20 and 50, and it's a higher low compared to the last one. What we've been talking about is the idea that, there's this resistance at 2665. The odds of us going up to a significant new high, not as high. Looking for it to stay around in this area. Now, granted, that was the expectation over here too. Again, for the same reasons, and we pushed up here with that tax reform bill. So anything can happen, right? From we were kind of in here, and then we pushed up this few days with that news of the bill potentially passing and then eventually passing. So news can come out and throw technical analysis out the window, but the same things that we're talking about here in terms of potentially going up to a slightly higher high, but not, nothing too significant. Well, the same thing is here now. Now here we have a bigger, longer upper shadow that can act as a resistance level. That can act as a resistance level, but it doesn't mean that we can't kind of mess around in here. You can see the momentum line getting up to an extreme level. Extreme on the upside is different than extreme on the downside. On the downside, it's below the 5th percentile, and the upside is the 90th. So you can see now we're starting to get some volatility in that momentum line. When it's just steady as she goes, you notice we don't get any extremes one way or the other, and we start looking for them to the downside. Well, here we got one to the upside and then to the downside. Got a little bit of volatility there, and then it continued higher, no extremes to the downside, but now we're getting upside downside again. So there's, the whole idea, this whole idea of volatility picking up here in terms of bigger moves. Now today's range wasn't very big, but you have to also account for the gap that we'll see here in just a minute. Regardless, it's almost like, well, let's see, the intermediate line did turn up slightly, but it's almost like we got a cluster. So we're back to a bullish posture, but again, grain of salt, because it just barely moved up here by what, two tenths of a point. The momentum line turning up again would suggest that turn bullish again, but remember we've been bullish now since the end of August, so we're going on 4 months again. We've had a 4-month run back here post-election. We went from beginning November, December, January, February, so see, November to December would be 1, 2, 3, and then that 4th month there, and we finally ran out of gas here. So it's the same thing here. We started in the end of August, so 1, 2, 3, and we're heading towards number 4, especially with the seasonality of this month. The issue is, are we going to be able to maintain a bullish posture but not go anywhere because of how much we've already gone to get to this point, and with some choppiness up here setting up some potentials for high points in the market. Market sentiment is turning down still, easily up above this 85 area, and you can, if I were to set that price at 80 instead, kind of the reversal zone like we see on the intermediate line up here, then you can see easily in the reversal zone, and well up in the reversal zone. In fact, we haven't even sniffed the lower half of the chart for a while. This, you can see market sentiment. All we're not seeing the whole 0 to 100 like we do here. We're seeing the like 60 to 100, not even 60, it's 65 to 100 essentially, or 65 to 90 at least. So that's the S&P 500. Still got a strong bullet, or got a renewed bullish posture. The near term, the Dow Jones not quite, and you can see, same kind of pattern, bouncing up. Expectations not high for a renewed or extended run here. The Nasdaq Composite, same thing. Bouncing up again, coming down from its open, so it's a little different there. Near-term line moving higher, intermediate line still pointed slightly lower, so that kind of shows, that with the S&P, just not that strongly bullish. Finally, the Russell 2000. Take a look at that one here really quick. Long upper shadow on this, and you can again see not the strongest of a bounce here. In fact, it was the S&P that did the best today out of all these indexes. See, the Russell's up 0.08 of a point, the Nasdaq 0.4, the Dow almost 0.5, and the S&P eventually, there we go, 5.5, so 5,500. So you can kind of see that this is the one that did the best. That's not the most bullish pattern either. So again, bullish posture, bullish trend, bullish bounce. Not a near-term bounce we expect to last a typical 7 to 12 days. If it does, more likely in the 7-day range than the 12-day range like we've seen here, and then a couple times over here. All right, so another reason why I don't think this near-term bounce is going to last very long. So we had, this candle. We've been talking about this idea that as we bounce into the end of the week, that we'll get up closer, we'll have a smaller body, something like this, up towards the top here. But again, look at that. Look how high the 15 and 100-day or 200-day moving averages are away from each other. And then if I were to change that MACD and take a look at it, the current price to the 10-day, and you can see that again. We're at these elevated levels above the 50-day. Excuse me. This is the 10-week, the 50-day moving average. And if I do the same thing for the 200-day moving average. Again, look how far up above. We are as far up above the 200-day moving average as we've been in the last, what is this, 5 years? 5 years here. And where's my, let me get this. Phil, let me. I need to get rid of that. One of these days it's going to let me do this. There we go. So again, here in 2017, that's as far up above the 200-day moving average that we got. Now remember, this is 2 weeks in a row now. We're this far up above the 200-day moving average. See that down here? So here we go right there. That's as far above the 200-day moving average that we got earlier this year. Come back to 2012, last time we were more than 150 points. That's what happened. That's as far above the 200-day moving average that we got. There's a couple other times that we were kind of above it, so you can see we, had some, fiddle around, came down to the 50, bounce. Again, same thing, came down and had a little bit more volatility. So, those are all the times that we've been above the 200-day moving average this far, and that's, again, why I don't think we're going to go that much further up without some kind of pullback, into this 100-point area. And that might just mean that we come down, at the least to the 50-day moving average and test around there again. And remember, we don't tank. We don't start to really show big volatility. I know for a lot of people, big volatility means like 15, 18 on the VIX. We won't start to see like 30 or 40 again on the VIX until we start getting a lot of arrows right next to each other, which means we got to start flirting around with this moving average, at least the 50, because that's where all these come from. And, of course, we've only had, since the election, we've only had 2 red arrows, and they were followed quickly within a week or two by green arrows. So you got to get a bunch of them back to back to back to back before. Again, now of course anything can happen, but the precedent is we start getting a lot more of those. You know, when we trend, boom, 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 we just keep trending. But then you start to pick up a little bit, and that's when we start to go sideways. Pick up some more, and then the MACD drops as these two lines get closer to each other. Whammo. That's when the volatility really starts to pick up again. Looking at the three green arrows, again, we had, the one red arrow, obviously way up above the 30-day moving average. Still pretty decently above the 8-day. We never did cross below the 8-day. The MACD itself is still above its moving average, never did cross below while the stochastics did. I wouldn't be surprised if the stochastics kind of hits its moving average, something like this over here, and then comes back down and continues lower, maybe a titch above that. So that's kind of what I'm expecting from this near-term bounce, is getting that stochastics 2 or maybe a little bit across, but not significant, and then pulling back down, the MACD itself finally dropping below its moving average. So here's the intraday chart, and so there's that gap. See the big gap that we had after the jobs report here. So we, the close at 264.04, the low at 264.72. So we're looking at about another 3/4 points of range. Higher high, higher low, closing at the high of the day with a little bit of a push there at the end of the day to get up to its peak. Volume still right around that 76 million mark. 1.5 point range. The low here got the 264.03, so I kind of filled in the gap there, even though in reality, it's just some kind of data point. But that gives us our range. Don't put a lot of stock into that long lower shadow, because, again, this is what it looked like on the intraday chart. It didn't come down to 264.03 on an intraday, 264.72. So, but it was still, we include the gap when we're figuring out that trading range, because then that's traded during there, and the reason why it gapped up is because it traded there in the after hour, in the pre-market. So we got about a 1.5 point range, 76 million shares being traded. We take a look at that in context. 1.5 point range. Need to pull up SPY here. 1.5 point range is below, but still relatively high. 70 some odd million is at or a little bit below maybe, but still in the middle of this range. So those are still, some pretty volatile numbers. Not as volatile, so we're below the averages, but still, when we're bullish, we're going to grind with 1 point ranges and 50 million shares. The fact that we haven't been able to continue the decline in the average volume here, we've been kind of holding steady around this rising average, is a sign that maybe we're kind of working out some volatility here, and that's our precursor to more, again, not a bear market, but at least a bearish intermediate run that can set up for another buying opportunity. So you can see the volatility really dropped. Now volatility typically falls on Fridays and bounces back on Mondays, so keep that in mind. That's a recent trend here. So again, big drop in volatility, big drop. Let's pull on the intraday chart. There we go. So we're coming down into this area where we've seen lows before. That's on the absolute basis. On the relative basis here, if we take a look, where is it? Here. Falling down to 76, 77%, below 77%. That's extreme lows again. So just like that, we're already at extremes in these volatility levels, but not extreme lows in the volume and the trading range. So that's if we were at small volume, small trading range today, I'd have been okay. We're gonna grind higher here, maybe for a little bit. Maybe we'll get to that 7, maybe up to 10 days. But the fact that volatility stayed extremely low, but the volumes are at this higher average, and trading ranges are also at this higher number, relatively speaking. That makes me think, okay, this near-term run may only last like a few days before we pull back down again with this increased volatility that we're seeing. Whether or not Bitcoin has anything to do with that over the weekend with the futures coming out on Sunday, whether or not that has anything to do with it or not, who knows? But from a technical perspective, that's how the technical picture is setting up for next week, that this near-term run may last maybe another day or two before maybe pulling back down and forming a bearish near-term high point. All right, so now let's talk about what's driving the price action today. And a quick reminder again to follow me on Twitter if you're not already for more content about what's going on in the markets from day to day. At DavidSettle42, there's the address up there at the top, and the follow button will be right over here, over on the right. And again, if you want Twitter to keep pushing you my tweets, you have to engage with them. That's how Twitter knows that you want to see them. So the easiest one to engage with is the one that's always pinned to the top, which is each day's market outlook tweet. Just like and retweet that there. You can see this is like one of the higher numbers that we've ever had, so I really appreciate that. And again, the thing I get out of it is the more that you engage, the more all my followers will see my stuff because of all the engagement that it has. I did want to point out this here. So for those of you watching these videos, when you subscribe, it was just a few weeks ago. This was my own YouTube account. Of course, I worked somewhere. I had a YouTube account there associated with what I was doing. This was my own personal one that I put some videos up. My kids playing the piano. I only had 5 subscribers, and those 5 subscribers may have been my family for all I know. But last night we hit 1,000. In just a few weeks, we have 1,000 subscribers. So that was a big deal for me. I really appreciate that, and appreciate all of you who subscribe to the channel and like the videos there too. And I know I ask you to do that every time, and to see the numbers. I'll have to say that a lot of people reach out to me because they see how many views these videos get compared to my subscribers, and how many likes each video gets compared to the views. A lot of people are looking at these videos as highly valuable. They've been reaching out to me for the opportunities to do things with the video, monetize. And right now, like I said, this is just me looking at the markets every day and kind of letting you in until Brandon and I get something more official going. So thank you very, very much for subscribing to the channel. So we'll take a look really quick at the calendar for today. The biggest news was the employment, the jobs number, still very strong. Not as strong as it was. As expected to come down, but it was better than expected. Nothing else really changed. The unemployment rate, the headline rate stayed the same. The average hourly earnings, you can see what bounced up to 2.4 from 2.4. It was revised down to 2.3, bounced back up to 2.5. Average work week ticked up a little bit. So all pretty decent numbers. Everything else relatively flat. You can see that the big number I like to look at here is this year-over-year growth rate, and it's not surprising that it's falling. It's been bouncing up, but it's bounced up before. The question is, are we going to bounce up to new highs? And we're getting some strong numbers, but the expectation is that, with considering how low the unemployment rate already is, it's a very, very low figure. I mean, look how low it is relative to where we were in 2012. When QE3 started. QE3 started in the fall of 2012, went all the way through the fall of 2014. So QE3 produced that drop from 7.5% to 5.5%. And then, of course, the election was right here. We were already down to 4.5%, and now we're down to 4.1%. So it's a very, very low employment rate. You can see inventories came out today too, and they were down, and that impacted GDP estimates coming back down, but still a pretty decent number, almost 3%. This is what I want to show you. So here's the rate hike expectations, and again, it's pretty much a guarantee there's going to be a rate hike in December. But the rate hike, the rate hike in March continues to really pick up steam. So that's what this gray line is, and then you can see a third rate hike before June is picking up, and that's kind of where the idea for this is, again, the economy's chugging. There's not a whole lot of inflation, but unemployment's really low, and if the fiscal policies end up being very accommodative too, with an unemployment rate that's already so low. Then the Fed's going to be worried about that inflation picking up very, very rapidly. very quickly, and so that's why you see these odds of more rate hikes coming in. And that's not a bad thing for the market. It can dampen returns. Usually you get a really good returns coming off of major market low points. Then the Fed starts to lower rates, and so it will slow down those returns, but it doesn't necessarily mean that it will be bearish. But at least, heading into 2018, that the idea is that, okay, there's not going to be as much accommodation, especially, if these fiscal bills get passed, whether it's tax reform now, healthcare eventually, infrastructure is rumored to be coming out, a plan for infrastructure reform. I believe it was in January I saw for that. So when these things come out and start to really pump some money into the system, then the Fed's going to be like, okay, they're taking money out of the system, but not that fast, and we're already, the economy's growing 3%, annualized every quarter, the last few quarters, with unemployment this low. They're going to have to do something to offset that. There's been precedent for the Fed to do that in the past, and most likely would follow that precedent again now. So as these rate hike expectations are rising, you can see the week. If I were to go here and just look at the week that was, the dollar is the biggest beneficiary from those higher rate hike expectations. You can see initially this week, bond prices were up. They pulled back down to break even by the end of the week. The large cap stocks outpaced small caps this week. That's not the most risk-on trade. Crude oil was actually really lagging behind. It's had a couple of days here and bounced back up. Finished the week with a 1.5% loss, but at least outpaced gold. Gold's really struggling with the strength in the dollar. You can see treasuries kind of holding their ground against high yield. So that's not the most risk-on relationship either. In emerging markets, international stocks outpacing small caps too. Large caps kind of taking over. In fact, today it was a S&P 500 day. They did pretty well, and the Russell pulled back. But emerging markets, again, that's a story that we've kind of alluded to all year long. It was this relative strength in emerging markets, and you can see that continues to be the case. There's a lot of potential there. They've had a good year. That doesn't necessarily mean that now they're done, because there's, like I said before, multiple years of underperformance. So when you're looking at your portfolio allocations, you're saying, okay, am I in all U.S. stocks right now? Because considering how overvalued they are and how mature these trends are, and how much international has been outperforming, there may be some opportunity to take advantage and position not a lot of your portfolio, but have some allocation there, more than what we've had, as international stocks had been lagging behind previously. Now they outperform, so we allocate a little bit more into that area to take advantage of that relative strength trend. The sector rotation for the week, the dominant theme, at least early on, was industrials, and has been. And you can see industrials finished the week strong. Financials kind of rebounding after lagging a little bit. They rebounded and finished the week strong too. Again, with this rate hike expectations helping them. Technology lagged behind the market, so it's like some leadership change here from what was the leader, technology. Now, technology had a good few days, but still, it's an industrial and materials, and those are economic growth sensitive areas. So that kind of jives with this theme that economic growth rates are picking back up again. On the other end of the spectrum, energy stocks dropping with the weakness in crude oil this week. But you can also see you have utilities, healthcare, and real estate, all your safe haven areas that pretty much lagged all week long. Utilities lagged all week long. So did healthcare, and real estate kind of tried to bounce up here, but ended up finishing below all these other sectors. Consumer staples held their ground, but with this bounce back up, they gave back some of their gains. In fact, over this 2-day rally, they gave back the most because they had the most to give back, whereas utilities lagged behind too. Again, safe haven. But look at what's led the way. It was technology a little bit, and then industrials. Technology pulled back, but you had industrials, you had energy stocks bouncing back and leading the way higher in the last couple of days. All right, well, with the technology sector improving the last couple of days, the stock that I want to look at with our trade idea of the day is Corning here, GLW. You can see, looking at the charts, on a nice, good trend, bouncing up today with relatively average volume, MACD and stochastics. Stochastics giving a phantom, green arrow, MACD turning up up above zero, not above its moving average yet. That's why you don't see a green arrow on the histogram. But you can kind of see how we've come down, the lines converge, we bounce, we bounce up, the lines converge, we bounce up again. If we take a look at the Bollinger Bands, you can see they're tight, relatively speaking, so there's potential for kind of a breakout move one way or the other. And if you had to guess, we've been trading above the Bollinger Band, the exponential moving average in the middle more than we've traded below. But I also wanted to show the seasonality. If I go to seasonality under style and change over, I got this over here too. Let's change this to a 10-year chart. It doesn't quite have the 10. Oh, we already got it there. Good. So you can see that we're starting a period now here and through the rest of the year and into the beginning of next year where Corning typically is bullish. There's a nice good rally. There's a nice good seasonal trend along with Corning. And one other thing I wanted to point out too was the relative strength of Corning compared to its sector. So it's in the information technology sector, and you can see it has lagged behind, since July middle of July. It's really underperformed, but it's been gradually since the middle of August been climbing back up again. So if I take a look at the chart here, you can see middle of July outperforming, and then bam, in the middle of August it's been gradually outperforming again. Now it's breaking up potentially to new highs here, but the relative strength is not. If I look at compared to SPY, you can see it's also crossing above its 200-day moving average. The relative strength line is with this week's move. If I take a look at GLW compared to the broad market, you can see it's been a better stock, relatively speaking. Even with this July to August swoon, basically got you to the 200-day moving average and bounce. Same thing like we had here, and we continue to move. So there's opportunity from a seasonal trend. There's opportunity from a relative strength performance after some pullback to continue this trend higher. So we say, okay, well, again, we don't know how long the market's going to be bullish, right? Because it's already been bullish, well, essentially since this whole time frame right here that GLW has been riding. So what we'll do is we'll say, okay, well, what if we just sold a put? Again, 31.5. If I take a look at the 31.5 put, it's got that mid-30s delta. We'll go out 48 days here to get a decent spread. So I'm not going to get a whole lot of credit here, but I'm getting a pretty decent probability of success, considering when I take a look at that break-even point on the chart, you can see I've got a lot of room to work with. And remember, we talked about yesterday, here is where time decay starts to work against you, and when the purple line crosses over the green, at that point, right now you can see the loss today would be 47 bucks if we got down to 30.5, and that would be the same loss at expiration, theoretically speaking, 30.62. You take a look at the chart here, and let's get this back to a normal price. 30.62 is way down about right there. So that's how far you have the drop before time decay starts to turn against you, and now essentially you end up with a long call option. Again, we're selling a put, so that means time decay should work for us, not against us. So we've got this break-even point, we've got that 30.62 area, and in the worst case scenario, no matter when it hits, based on this chart and the current volatility levels, we're going to lose. If we get down to that point, we'll be down 46 bucks. We're trying to make 42. So you got about a 1-to-1 reward to risk ratio at worst, because obviously that would be your time to get out of the trade. And of course, if you got out any earlier, we're looking at right now, let's say we dropped down below this support level, and really you've got the long lower shadow, the low point of this long lower shadow, which is 31.20, Well, if we drop to 31, below 31.20, say down to 31, then we're looking at a $34 loss today, and then that gradually moves up closer to $9 by expiration date. So between $34 or less compared to a $42 potential reward that we have a high probability of achieving, you can see how we got a pretty decent reward to risk ratio with a higher probability and decent technicals pointing us to a potential bullish move on the stock, even if the broad market doesn't suggest we'll get a big bullish move from a all the rising tide lifts all boats, so to speak. But there's opportunity, at least in this individual issue, due to some potential outperformance after recent relative weakness. All right, so to summarize, the market had a great week this week, and well, at least it had a better finish to the week, and we expected a short-term, near-term bounce heading into the end of the week. The question now is, how much further can this go? And of course, the expectation is not very much longer. Not that we're going to tank, but that now we're just going to kind of muck around in the upper half of this 4-week range here. Maybe get up to new highs, but not too dramatically big, because the 4-week range is already pretty large considering. And so we have to be really choosy. The trend's still bullish. The posture has turned back to being bullish. We don't know how much longer it's going to be bullish because it's already been there for a few months. So we have to be choosy with the trades that we make. So today we found a decent upward trending opportunity. Dial back the risk by doing a short put vertical instead of saying buying stock or buying a call option. And looked for some technical factors to help support it to try to increase the odds of success, including things like seasonality and things like that. So you can kind of see we can still trade in the direction of the trend, even if we expect the trend to at best go sideways. We just have to be very choosy and picky about what we find, and even with that, nothing's a guarantee. So we manage our risk. We use a smaller position than what we normally do, and use all the evidences that we got and see what happens. All right, so thanks again for watching. I appreciate your time. Remember to subscribe, like, and comment on the YouTube video. Also, for those of you who follow me on Twitter, remember to like and retweet today's market outlook to make sure Twitter keeps pushing you the content that I'm producing. I really appreciate for those of you who do that day in and day out. Have a great weekend, everybody. I hope you have a good time. Next week will be an interesting week from the market standpoint, so keep coming back for more. We'll see you guys on Monday.